I'm thrilled to have two exceptional, thoughtful investors, both personal friends and extraordinary thought leaders in the industry, Peter Algert and Leah Zell. Per the request of HedgeWorld, I've been asked to ask each to introduce themselves, talk a bit about their respective roles in their firms, and then go right into some prepared Q&A. Peter, would you like to start?
Sure. We are a global equity firm in San Francisco, and we primarily focus on hedged equities. So our axe is looking at very broad sets of stocks across the world, 12,000 stocks that we cover. We use systematic models, so we're sort of in the quantish realm. But looking at Mark's talk, I agree with Rachel. It's a bit like the wide receiver wanting to throw the ball long, and those are the exciting plays. We're sort of like the fullbacks trying to move our public plan sponsors, primarily our public plan clients, up from that 4 to 6% bad outcome closer to the 8% outcome that keeps things going. So we'd love to follow up more.
Thank you. Leah?
Thanks very much for having me.
Of course.
So we are based in Chicago, walking distance from here. Lizard is a long-biased fund that invests exclusively outside the United States, and we specialize in those equities that are below the institutional radar screen. Our median market cap is about $1.3 billion, and we feel that this is an orphan universe of companies that are increasingly not being looked at by the larger hedge funds as the industry consolidates. And we feel that there's a rich universe of values to be found there. That's about 75% of what we do. About 25% of what we do are situations that are mispriced, overlooked, or we really feel that there's an asymmetric risk-reward situation. We do that both long and short, although we are more long biased. And our book is fairly concentrated. We run around 25 names.
Perfect. Thank you. Peter, I'd like to start with you. What do high profit margins tell you about the economic cycle, notably equity risk? Could you speak to that?
Yeah, and again, just following up on that presentation we just saw, I think there's been a growing din. It's kind of gone in waves over the last several years about the developed markets in particular being overvalued, and particularly in the U.S. pointing to high profit margins. You'll see Jeremy Grantham and others talk about those being one of the alligator jaws that have to collapse. And from our perspective, we don't view that as an important criteria. It's really about return on invested capital. So if we look globally at lots of stocks and countries and sectors, we see profit margins in the U.S. obviously very high, but the return on invested capital is sort of a different story because the asset base for companies has gone up. So I guess our cautionary tale would be people are mixing in a lot of information and looking at very aggregate numbers to slander the stock market, which may be a valid thing in terms of the cautionary tale for the equity risk premium. But we see opportunities in sectors, the changing sector composition, and certainly in stock selection. So I think it's just sort of a red herring, and it maybe goes with the talk that Mark gave about the fact that people are trying to paint a broad brush. So that would be my initial comments.
Perfect. Do you see high profit margins as prevalent overseas as in the U.S., since your focus is largely there?
Well, let me go back to what's going on in the U.S.,
Yes,
and then that'll help me answer the question for
Perfect.
overseas. I think you have to look at the U.S. high profit margins as having a secular and a cyclical component. Profit margins have been going up since the 80s in the United States, so it's not a new phenomenon. I would say that you really have to look at two periods, 1980 to 2008 and 2008 to the present. The first period, remember the starting point. Remember the inflation of the 1970s and how it ravaged corporate profit margins. And the easiest thing for corporates was to pass that inflation through both on the pricing side and with wages. And that coincided with the drop in interest rates. And so you had a very, very gradual increase up until the financial crisis. And it was fueled, of course, by the credit boom. Post-2008, we have an extension of this phenomenon, but for totally different reasons. And that is that with what happened in 2008, everybody got productivity religion. And so you have cost cutting, you have wage suppression, you have low interest rates, you have cutting back on CapEx, you have lower depreciation, you have more profits from overseas, and tax fiddles. Okay. so that's the background in the U.S. Okay, outside the U.S., you go through the same things that have affected the U.S., and not as many of them are there. Europe has had some of the same inflation, but not as high, some of the same cost cutting, but much more rigid labor markets and less ability to suppress wages. And then you've got the European sovereign debt crisis and austerity. So European profit margins have actually been about flat for the last 15 years. And the country that's closest to the US is the UK, because it has the culture that's closest to us. If you go to Japan, profit margins have increased, and particularly since 2008 because of a weak yen. But there they are at a level that's half that of the US. And as regards the emerging markets, and we can get into this if you want to go into it later,
Sure.
I don't think the emerging markets are a profit story or a profit margin story at all.
Yeah, and I would amplify that. We see the more interesting stories being in Asia, where profit margins are stable, maybe outside of Japan, growing in Japan. And another aspect to the U.S., to complement what Leah said, is we see a growing asset base, so more assets required to report the same level of sales, kind of the productivity story. There's more capital, less labor in the equation, which does lead to higher margins, but the same return on capital. So it's a changing kind of in the industrial organization, but that phenomena is not quite the same in Asia. So very different properties there.
Could you maybe expound a bit on the distinction between emerging and developed markets?
It's a marketing distinction more than it is an economic distinction. Right. When I started in the business, you have to remember emerging markets really were not investable before the 90s, so it's a relatively new asset class. India you couldn't invest in since 93, Brazil you couldn't invest in since 98. Asia started a little bit early, but then crashed spectacularly in 1998. So we think of it as this asset class, but it really has been so defined with Jim O'Neill's coining of the term BRICS. Okay, right. So and call it 2000, places like India were not emerging markets; they were frontier. So now the whole spectrum has shifted, and frontier is now Bangladesh and Sri Lanka, and India and Brazil are emerging. There are different groups. Some of them are oil importers, some of them are oil exporters. I mean, you know, some of them are commodity buyers, some of them are commodity exporters. I think the story in emerging markets, there are, you know, it's like the human race. They're all different, right? And you can, at this point, people are starting to group them. What I look for in emerging markets is structural reform. I think that's really the key. If you get a structural reform like you did in Brazil when Cardoso introduced the Real Plan, you got a decade of multiple expansion, economic growth, terrific equity markets. Mexico is going through a lot of economic reforms right now, structural reforms. It's early days, but you might see something like that unfold. India, you just had a new president elected, a total inflection point relative to the Congress Party that has run the country since independence from Britain. He's pro-business. The business community in India is absolutely wild with ecstasy over this. Early days, see how it plays out. But the pattern in emerging markets is that they need to continue to liberalize, improve competition, open up their markets, make them more efficient. And when they do, they get this great ramp up, and then all the vested interests say, oh good, I'm now rich, and it plateaus, and you need another impetus.
Makes sense. Yeah, Peter, thinking about Algert Global, recognized as one of the top most respected quant equity firms in our business, from that perspective, what other fundamental metrics beyond profit margins are central to investing in today's markets, and more importantly, why? Could you give context with that in how you build portfolios and think about your job as an acting fiduciary?
Absolutely. I mean, we tend to look at enterprise value to abstract away from some of the issues about equity and debt issuance and the stock buybacks changing the leverage ratio. So we're primarily looking for both the profitability of the enterprise by EBIT, and then as well as the sustainability of those profits through analysis of the financial statements. And going back to Leah's comment on the emerging markets, when you employ that in the emerging markets, we see just tremendous opportunities for stock selection. And I think the point that we talk about so much when we were just at Cambridge is that there is a tremendous concern in the investment community about where the return is going to come from. I think it's leading to a lot of this, we'd love to hear the stories about the 10+% opportunities, but people are having to find some mix of assets that are going to get them enough return. And from our perspective, in the emerging markets and in Asia, relative equity valuation, hedged equity selection, including some sector bets, is a great way to put 4% on top of whatever your systematic risk exposures are in your portfolio. So all of those other asset classes are great, but from our perspective, we see fundamental valuation with just traditional, from our perspective, systematic fundamental analysis across the financial statements. We're looking at what's happening primarily with the cash flow statement to look at the value growth life cycle of the firm and the sustainability of those numbers. Volatility is a really important metric for us, not volatility in the markets, but the volatility of the firm's fundamentals. Going back to the CAPE ratio, which gets talked about a lot, saying equities are overvalued, it's very important to understand that a portfolio of the valuing the index, it's actually a portfolio of stocks. Stocks are underlying options on the businesses. A portfolio of options is more valuable if the underlying volatility of all those businesses is higher. And in developed markets, business volatility has come down. And we see that certainly in the US and Europe. It's not so much something you'd see in Asia and the emerging markets. So you might see the same PE ratio in the market. That's actually bad if you consider the fact you're going to get fewer four-baggers in that portfolio of stocks going forward, because firms they've changed the way they do business, whether or not it's information management, CRMs, relational database. Profit margins are mean reverting more quickly than they were 10 years ago. That's a very important thing in what we do. People look at how quickly profit margins mean revert to identify opportunities. But that thing is compressed so that there's less fundamental volatility in the developed markets, which is certainly bad for aggregate valuations for equities.
Could you expound just quickly on that, on the technology factor, the fact that one might have the foresight or be more prescient because of the benefit of the technology you're outlining? What can one recognize really with the new developments in that aspect of technology one couldn't find before?
Well, I mean, in terms of the way businesses are changing,
Exactly.
I mean, from us, it's really, we can't understand the underlying mechanisms at each level, but what we see is in portfolios of stocks and the ones we're building, we're looking for firms that are going to have that business volatility with a stable base to give us the asymmetric risk return pattern. And we certainly just recognize that when you see that trend over time changing in a meaningful way with reduced volatility, you have to be very careful about looking at long averages and particularly valuing aggregates.
Leah, based on the clear strength of your conviction, what investment opportunities, long or short, does today's market really offer from your perspective? What are you seeing that the audience should be thinking through that you think is really paramount to thoughtful investing?
Okay, well, starting with the emerging markets, you have to be very careful because although aggregate price earnings ratios look to be at a significant discount to developed markets, if you exclude banks, commodities, and certain industrials, which represent 50 to 60% of what's traded in these markets, and I'm not even mentioning the state-owned enterprises, the adjusted price earnings ratio is about the same as it is in the US. It's closer to 17 to 18 times. So, we like to look at the non-commoditized portions of those markets. That notwithstanding, I think emerging markets with structural reform potential, as I intimated before, are a good place to look. Second good place to look is Japan. Not at the aggregate level, but there are certain things that are happening to Japanese culture, corporate culture. They have introduced a new stock index which is only for the companies that behave, meaning the ones that aren't hoarding cash, the ones that have decent return on equities, the ones that subscribe to a corporate governance creed that is friendly to shareholders. Brazil has a similar part of the Bovespa, which is limited to companies that conform to shareholder-friendly policies. There are now companies in Japan on the margin that are starting to buy back shares, that are starting to close down divisions. This is going to take time, but as the corporate culture changes in Japan, there will be great opportunities, because adjusted for the inefficient balance sheets, that is perhaps the cheapest market in the world, the cheapest developed market in the world. Third of all, I have to tell you, this is a bit talking my own book, below a certain market capitalization, no one is out there. It's there, the competition is gone. You can do a little chart of what kind of liquidity you need if you have a $100 million fund, a $1 billion fund, and a $5 billion fund. You get to a $5 billion fund, 90% of what you can buy is no longer on the radar screen, and there's very rich pickings there. So that's on the long side. On the short side, two comments. Companies that have high margins that we feel are clearly over-earning. And an example would be companies where a high percentage of their earnings are coming from China, because that's been a hot place, and that is a place where I think margins are likely to mean revert, because the Chinese aren't going to let the foreigners make that much money off of them. The second area, which you saw clearly the first shot across the bow this year, and that is what I call .com 2.0. And finally, the last thing I would say is, after risk on, risk off, ever since the financial crisis, stock picking is back.
Quick question to that end. Most in trying to procure intel the way that you have would do it one of potentially three ways. One is some type of quant model that could optimize best ideas based on big data. Another might be a bottom-up fundamental process whereby boots on the ground are instrumental in evaluating the emerging market in first person. And the last would be typically some socioeconomist or macroeconomist that would give some type of macro thematic view of the market. I'm just curious to know, in constructing these convictions, what parts of those lend themselves to building that interest?
So the universe I inhabit,
Right.
you can't screen very well, because the data is stale and corrupt. So you can screen a little bit, but it isn't as productive as it is for very large cap companies where the data is scrubbed and everybody knows it and it's kept up to date. The boots on the ground thing is something that I've dealt with my entire career, and I had a wonderful conversation with the head of one of the oldest and most respected fund of funds groups in Geneva, and I was at the time running a European small cap fund to sell into the European market from Chicago. And this guy turned to me and he said, "What do you know about Europe? I'm sitting here in Geneva." And I turned to him, "What do you know about Stockholm?" We all are someplace, right. And you're never going to out-trade the locals.
Sure.
On the other hand, there is truly an advantage to being able to have a certain emotional distance and to be away from the noise and to be able to make a comparison between a company that does machine tools in Japan versus a company that does machine tools in Germany, because they compete against each other. And being in Germany is not necessarily going to tell you so. So I think what is important is modified boots on the ground. Right. You must talk to management. You must do what I call deep dive research. You must do independent research. The sell side is shrinking. The quality of the sell side research, and it still can move markets short term, but at the end of the day, I think you have to do your own work. You have to stay away from the noise. Chicago is a great place to be, but it's really about discipline, endurance, focus, and patience. I think those are evergreens for investing, and I do think that ruthless elimination, it matters what you own, not what you don't.
I would just agree with Leah in the sense that we see just tremendous opportunity for stock selection in small cap globally. They're poorly followed companies. The asset management industry has become more concentrated. Bigger firms forced to really play in the larger cap names. So we see a lot of mispricing there. our perspective is obviously different in that we like to look at 6,000 small cap companies globally, and so the detachment from the emotion that gets into the local market home country bias and that perspective of the valuation is an advantage for us. But we do see a lot of opportunity there for hedged exposure in small cap equity in our case.
If we learned anything from yesterday's sessions, it was that alpha is expensive and beta is a commodity. We heard that in just about all the discussions at the end. Thinking the fact that most of Algert Global's clients are large U.S. institutions, many of whom are seeing a proclivity toward and an interest back into thinking about quant equity. Could you maybe speak a little bit about the context? How would one be using quant equity in a diversified portfolio today to express a forward-looking alpha generative goal, since so few are meeting their actuarial assumptions?
Yeah, I mean, I think it goes back to that. If your return target is 8%, where are you going to get it from? You're not going to get it from equity risk premium. Very hard to get any systematic risk premium. We're all reaching for the alternative classes. I haven't been to a meeting in the last 12 months where people haven't asked us if we'll do frontier markets, which is, to me, maybe a little scary that everybody with big $100 billion client plans wants to do frontier markets. It seems that there's not the gas there for it. So what we see is stock selection layered on top of maybe a 3 or 4% systematic risk premium portfolio, which could be a mix of stocks and bonds. Maybe it's 5 or 6% if you've got more emerging and frontier in there. You could put 3 or 4% stock selection on that with a diversified portfolio, smartly constructed to reduce some of the correlations. And it's a way for plans to get back to a sustainable return target. If you need 8% for the foundation, the old model, people are looking at my historical returns have been 8 or 9%, but I've done that with an average over the last decade of 3% cash. So I've done 5 to 6% above cash in a market where we've seen risk premium get bid up, right? So we see multiple expansion. You're not going to get that multiple expansion. You're going to see multiple contraction going forward at risk pricing going down. You're not going to be able to get the same sort of returns, anything like it going forward in a zero interest rate environment without putting something different into the portfolio. And from our perspective, we see stock selection as part of that.
It's perfect. You're nodding. My guess is that you have something to say on that topic.
Well, I'm thinking about the frontier market comment,
Right.
and the truth of the matter is that those markets are capacity constrained.
Absolutely.
You cannot, in the last presentation we saw that Africa, that the total market capitalization was, what, 0.3%
Right.
of GDP?
Right.
The category has to grow, and there's a lot of money flowing into it. And I think I'm a big believer that the industry has evolves, but that the underlying fundamentals of investing are evergreen. And one of the underlying investing fundamentals is that it's better to be a capital provider in an area where capital is fleeing than to be where the capital wants to go. And it's hard for all of us because it's not emotionally what we want to do. That's why people buy high and sell low.
Right. Many people have tried to emulate a lot of what you do so well. What do you attribute their lack? Is it lack of will, lack of intel? What falls down that makes them?
It's very labor intensive.
I see. Fair enough. Also, Peter, I was understanding that that you at Algert Global, you don't have formal PMs. I understand that the title is model manager. Could you speak about what a model manager is at Algert Global, and in the context of how you construct portfolios with this kind of hybrid type?
Yeah, I mean, it's having been in doing quant equity for almost 20 years now. You see there's often a separation of people doing screens at maybe at more traditional shops and handing it over to analysts, and then sometimes portfolio construction, oftentimes systematic firms, or having people build models that generate theoretical portfolios and they throw it over a wall for somebody to implement and maybe try to shape the portfolio. And from our perspective, we're just unique in the fashion that we have the people that actually have the statistics and the data to do the models, and they're really simplistic models. I've been talking about enterprise value, but they're the ones actually doing the trading as well and constructing the portfolio. So we're just unique in that regard, in that we're kind of soup to nuts at each individual people as opposed to a divided firm.
I'd like to finish with one comment from yesterday morning's panel, which is that the risk management is no longer the bottom right box of an investment process. It's actually paramount in some ways, the first thing one thinks about. You know, in that context, can we just talk about, just briefly, Leah, from your perspective, what is the biggest risk in thinking about your coming into and building your portfolio that you've been able to thoughtfully mitigate?
The one that I am most asked about most frequently is currencies.
Currency risk, yeah.
And I did an essay last fall about, and I hedge out half of my currencies across the board. I have a little fun as to picking which currency I wish to hedge, but I keep the portfolio half hedged. And over the 5-year period, it has cost me 0, and I've probably made 1% per annum on it.
Perfect, that
So
works.
it's been much ado about nothing.
Right,
So that people perceive that as a huge risk, it actually in reality has not been that much of a risk. I think when you're investing in equities, your risk is always at the level of the specific equity you own.
Right.
The big, broad sell downs, which make everyone scared, invariably come back. Unless, you know, and if there's a permanent economic meltdown, there's no place to hide. You can't really risk mitigate against it. So it really, to me, the biggest risk is making a mistake on individual security analysis and selection. And so over the years, I have become much more cognizant and attentive to downside risk on the buy price. When you're involved in the equity markets, you are a price taker. It's not, you're not buying a company, changing the CEO, moving parts around, and literally create, you're a passive player. And so your entry point is critical.
That's perfect.
And if
yes.
I could just add from our perspective, it's similar to what Leah just said, is it goes to that Baupost quote from Seth Klarman. The biggest risk for us is the change in psyche back to risk awareness. The risk off, when risk off becomes real again, there's going to be credit spreads are going to come off the bottom. That affects value investing, which is a big part of our, we may be hedged equity, but we have an exposure to global systematic relative value. And so when the psyche changes, so we're very keen on understanding sentiment and where that change to the risk-off sentiment might come. And just a specific example of that is Japan. People that do what we do in Japan, our returns are very correlated with flows into and out of Japan by foreigners. This is the global risk on, risk off, specifically as it relates to Japan. So that's our biggest risk, which in terms of preserving capital.
Well, you also have the argument, too, of demystifying the myth of quant investing or quant equity investing. Maybe you could speak about that just a bit as we wrap up as well, just the fact that it's not as potentially opaque and seemingly intimidating as one would think when you...
Well, quant is interesting because if you look at some of the most esteemed track records in the business, there is, Citadel maybe in some ways has a significant quant book, a good track record. Renaissance, a lot of people talk about. They only manage their internal money in the Medallion Fund. The Peter Moeller book at Morgan Stanley from Nunzio Tartaglia. So systematic investing, I think, has good credibility over a long track record. But what those guys do is black box. They're people, many of them that find submarines in the sea as their training. What we do is really systematic equities. I mean, we like to read the same books as other people, and what we do is very simple. We just try to take emotion out of it and explain it to people that way. We're betting on basic fundamental principles.
Thank you. Please join me in thanking Leah and Peter. We're not going to go to Q&A, but they will be around for any direct questions. And I can't thank them enough for their time and effort. Thank you so much. Thank you.